Hello everyone. Over last couple of months, we have seen important events like vote on account budget and monetary policy by both US as well as Indian Reserve Bank of India. On the budget front, we have seen concentration of the government on fiscal consolidation as well as on growth. On the fiscal consolidation, we saw fiscal deficit coming down from 5.8% in FY24 to budgeted around 5.1% in FY25. On the growth front, we have seen the focus on capex being maintained in next year as well as in this financial year, where we have seen capex being focused so as to give priority to growth. On the fiscal front, we have seen that all the assumptions which they have considered while assuming some consolidation and also focusing on growth, we have seen all assumptions being quite realistic. On the policy front, as far as US FOMC goes, over last couple of months, mainly towards end of current year, calendar year 2023, we have seen FOMC concentrating on higher quantum of rate cuts and also earlier timing. But as the data on employment, data on GDP, data on inflation came in, we saw the focus of FOMC reducing from a quantum perspective also, and from timing perspective also, it got delayed. This, along with the local data, especially on inflation, growth and liquidity, had implications on RBI monetary policy decision also, which is in a wait and watch mode. And also going forward, the projections on inflation above 5% has been reduced to 4.5% and growth is maintained at 7%. From a market perspective, we have seen GSEC levels, GSEC 10-year benchmark level hovering between 7% to 7.25%, depending on the news flows. When the consolidation budget news came in, we saw yields coming down. At the same time, we had seen, because of global uncertainties, we have seen yields going up to 7.25% also. On the corporate bond and SDL front, we saw initially the spread widening because of liquidity issues, because negative liquidity was increasing into the system. Whereas as the budget consolidation news came in and other news came in, we saw levels contracting a bit, and currently we are around 40 to 60 basis points as far as these spreads are concerned. The main mover of the market was liquidity, which in fact the negativity in the liquidity increased to current around 2 lakh crore. And the main reason for liquidity reducing in the system was basically less expenditure by government, which is evident in the fact that government cash balances as of now are around 4 trillion. The impact of this on shorter end of the curve was that the extreme shorter end, that is 1 month to 3 months, which are typically taken into liquid funds, we saw the levels going up by 30 to 40 basis points, and as we speak, the entire yield curve is quite flat to inverted. So looking at the global picture, looking at the domestic picture, and also the upcoming elections and geopolitical escalations which are happening in between as far as Red Sea issues are concerned in the current scenario, we feel that as far as monetary activity or rate cut activity is concerned, we will see consolidation phase over next couple of months, wherein liquidity will be the main driver for the market. Liquidity will be controlled by Reserve Bank of India, as they are doing it right now using various instruments like VRR and VRRR. And as far as our funds are concerned and our view on funds are concerned, we are expecting that over a couple of quarters we will see a downward trend in interest rates, not only locally but also globally, because obviously domestic markets will have good enough of weightage as far as global rates are concerned, and obviously domestic factors are also supporting our view. In this scenario, we are maintaining higher duration in most of our schemes so as to benefit from the future fall in interest rates. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.